Hi guys, welcome back to the channel. My name is Dave, and recently I had the opportunity to sit down and talk with Sylvia Jablonski, the CIO and CEO of Defiance ETFs, about their lineup of products. And that includes the fascinating 0DTE option income ETFs that they released back in 2023. So these suckers yield about 60%, that's the distribution rate, and we can count on it and retire in about 3 years, right? Well, maybe not. Let's talk and find out. If that is what you're looking for, please stick around. So the first three ETFs that we're going to hear about from Sylvia are QQQY, JEPY, and IWMY. Now, I have reviewed these before, and I'll link that video up above. It goes into the details, the mechanics of how these work. But they basically take your money and they keep it into short duration bonds, T-bills, things like that, to give them a base layer of income, 5%. Then they're going to go and they're going to sell in the money puts. And when you sell an in the money put against whatever index you're buying, in this case, whether it's the NASDAQ, the S&P 500, or the Russell, when you buy these index options, this in the money put, it's basically intrinsic and extrinsic value. Since it is an in the money put, it will have a little bit of intrinsic value at the beginning. It will also have that extrinsic value, which is like the time value of the option till expiration. That you're always going to keep, and that's what they distribute, and that's why it looks so great when you're seeing 60%, because they're always going to collect that and they're always going to go distribute that. And we'll get into the why of that too, and why they decided to build the ETF this way. But the problem is the intrinsic value of the option, right? There's a little bit of built-in. When we sell this, we collect that, but when we have to close it, depending on what happens to the index that day, depends on whether it's going to be a profitable option or not for us. So with that said, keep that in mind. We're going to hear Sylvia's take on these three ETFs.
We were looking to launch basically funds that pay outsized income on a monthly basis. And so we're, scouring the ETF market and, the different products that were out there. And we saw that there's kind of a lot of the same thing. There's, a lot of covered call strategies, and they, return like 10 to 15% on the income side, and then they may or may not get upside. And so we thought, there could be a better way to do this. And so our trader, who's, spent years, portfolio manager, his name is Jay from Sega Financial, he spent years and years trading options. And so he, was actively trading these 0DTE options, which are basically options that expire, within a 24-hour period, or 23 hours, 59, less than a day, basically. Right. And, so he actually had this brilliant idea that you could, try something different and do a daily put right strategy. So instead of, kind of the classic covered call strategy where you have like one shot per month to get your income, you have a bite of the apple on a daily basis. We sell slightly in the money puts. We gather that extrinsic value on a daily basis. And then at the end of the month, we essentially pay out the dividend. And so the way that they work is that, you obviously have the opportunity to gather performance as well. So you have, kind of wherever the index is trading versus the strike price to potentially gather every day. But the bigger thing is you're gathering that no matter what, that income from selling the put. And, European style index options, so you can't be put the stock. There's no, kind of like risk of that. And then, we've been looking at it, and over time, so for QQQY, for example, that's the one we really kind of tried to back test because, the ODTEs were out for about a year before we launched them at that point. And it looked like we could get conservatively 25 basis points a day on the back test. And so then, we thought, if we can get, anywhere from 0 to 1%, obviously has to be higher than 0 to be compelling, but we could generate these 50 to 60% annualized divs. And so, we've been doing that. QQQY is in the high 50s. We've had distributions around the 60% range, high 50s, IWMY 70%, and then JEPY, which is the S&P 500, has like that 40 to 50% range going on it. And yeah, so these ETFs have been out since last September. They've got close to 600 million in assets. They grew really fast. People are interested in them. And yeah, they've been a good, good product differentiator for us for sure.
Now, it is important to understand that with these three products, you will have NAV erosion over time. No doubt about it in my mind. You can't distribute 60% and hold that NAV steady. But they understand that over at Defiance, and we will hear Sylvia's comments about NAV erosion here in a minute. But if we go back since inception, I think each one of these is up about 8 to 10%. I mean, that's been in a very good market. So it'll be interesting to see if the indexes fall for a period of time, what will happen. But so far, so good. The option strategy seems to be generating some income, up about 8 to 10%. But let's hear Sylvia's thoughts on NAV erosion.
With these funds, our intention is that, people will kind of do a little bit of PMA, portfolio management themselves and reinvest, whether it's in our fund or, something else in the market, but you want the money to work for you to really have a stronger total return within your strategy. But yeah, I mean, I think, so the masses this has come up so much, and the masses have spoken. People really like the juicy dividend. They're reinvesting it, and they kind of don't want us to do anything, but completely fair point. There's definitely been a group of people out there that was thinking, well, if you could study the NAV a little bit, I could take a little more of my premium instead of reinvesting it. And, so really for us, we have seen just enough interest in the product, just like how it is, and it's working for people. And then, we're just now also bringing out products that do what the other crowd wants, where they can just take their dividend, which is like what SPYT would be. Yeah, like the fund is not going to return 60%. And I think that's something that, we're trying to make sure we spell out. Like the extrinsic value of the dividend that is paid on a monthly basis is 60%. If the market didn't move a hair, then it could return 60%, right? And if the, and then also, like, we're not trying to beat the NASDAQ, right? So what happens is, or any of the indices, like if the index is down on a particular day, we'll actually outperform because we get the cash, right? So you get a little bit of a softening to whatever, downward performance you have from the index. But if the NASDAQ starts ripping, like, we're never going to catch that, right? Because we have like these daily strikes. We're going to capture some portion of that. But over time, in a bull market where growth is trending, that's going to outperform. So this is really for the retail investor who wants alternative income. Like, that's a really important point. If you look at like standard deviation, Sharpe ratio of this, like, it's actually less volatile than the S&P and then the underlying index that it tracks. And it pays this, steady, outsized income amount. And so that's what people tend to like about it too. It's like low vol for high div.
Now, the next ETF that we discussed is SPYT, and this is more in line with the covered call ETFs that we've discussed before on this channel. Now, it doesn't return 60% as far as the distribution rate, but it is 20%. 20% distribution rate is still pretty darn high. So we'll see how this progresses. But how do they do that? Well, the first thing they do is they go out and they buy the S&P 500. In this case, it's IVV, or the iShares S&P 500 ETF, and then they're going to sell index call spreads against that position, and I'll pull up the position currently. So I still 0 DTE, it looks like. I've heard sometimes they'll go a little bit longer duration, but still very short duration. And a call spread is quite simply look at the current price, go slightly above it and sell a call to collect income, then go a little bit further out to define your call credit spread. Okay, and that's going to be less money because you're buying it further out of the money. So you're going to collect a little bit of income like that. So you get to participate in the down, you get to participate in the up past that call side, the long call. And this way you can generate some income. So this one makes more sense, more in line with what I would typically do with some of these funds that I already currently own. But let's hear Sylvia's thoughts on SPYT.
And then actually it's pretty interesting too, because we launched a fourth product, which is like a cousin to this. And so the other one that we did is called SPYT, and it's a similar vibe. But the difference is we kind of created like target income. So that one is, we're trying to deliver 20%, annually, annualized monthly, and just keep the NAV steady too, right? So kind of like keep the NAV flat. So there are two ways to do it. You can have like that lower yield, which is still very juicy, but have more NAV stability. Or you have these products which are like lower vol as compared to the underlying index that they track, and higher dividend.
And the last two ETFs that we discussed are QTUM and FIVG, or Quantum and 5G, which are really more up my alley. I'm more of a buy and hold ETF guy, but I still buy into some of these covered call strategies, as you know. But if you're looking for some long-term tech exposure, these two look pretty interesting. And honestly, out of the two, I'd probably pick QTUM for myself to buy and hold.
QTUM is our quantum ETF. And this is so interesting because in 2018, the thought was that AI is definitely going to be a thing,
Yeah.
and if AI is a thing, that means, you have robotics, you have machine learning, you have cloud, you have supercomputing, you have like visual graphics, all of these things are going to play into the ecosystem of the stocks that are required for and grow around AI, right? Innovation. And so we launched that ETF, Quantum. It's always like performed pretty well. I mean, 2022 was a terrible year for tech, so
Sure.
it performed like tech did, but it's done super great. And what it does is it has 71 names in there, and they're all names that are relevant to AI, machine learning, and quantum computing. And so again, like we just think the future of AI is, chips for sure, right? So you have all the chip companies in there, but quantum companies, quantum computer companies, supercomputing companies, companies that are actually like parsing data quickly, precisely, and efficiently so that, the language models or the robotic surgeries or the defense systems, the targets and the missiles and things are actually working on the, most available, again, efficient, quick data possible. And so, with different probabilities and outcomes, which quantum computing allows you to do and solve for. And so we built this ETF for, just kind of anyone who believed in that, right? And then Microsoft ChatGPT, it's like the ChatGPT moment. As soon as that happened, I think people found the fun. And now, so anyone who, and so ETF, it's so interesting, right? Because a lot of people say to me, like, why wouldn't you just hold NVIDIA? Like, NVIDIA is everything, right? And so, fine. But the problem is and I hold NVIDIA. I've held it forever. But NVIDIA is very expensive right now. And it's one stock, and there are diversification issues. And there's China, and there's all this stuff. And so I think when you have, like, actual disruptive technology, like, instead of I think people often use it as like just like a marketing term, right? But like I think actual disruptive technology that is, kind of like happening now and happening in the near term and isn't like so futuristic that you can't touch it and you don't know what it'll end up with. It's great to look at ETFs because you're going to have the small cap names in there. You're going to have the smaller, less known companies like an IonQ or Getty. One of these companies can end up having a huge M&A deal. One of them can end up, discovering the thing that makes quantum computing actually commercial. And so we like the idea of just diversifying all of the machine learning, the AI, the supercomputing into one product. And the other good thing about us is, like, you'll notice we're cheap. We try to, we initially launched the company with the idea that we were going to target like the next generation of investors, right? So like my 4-year-old son is, not to like knock on QQQ or whatever. It's again a fund that I own and I've owned forever, and I own to like help pay for his college one day. But like,
right.
He's probably going to care more about quantum computers, and he's going to care about, a NASDAQ 100, whatever it is. So I just think that, our whole thing was like, we want to present this thematic disruptive innovation at a low cost for the next generation to participate in this. And then it turns out actually that like our biggest holders are, huge models, RIAs, and wirehouses. So, everyone likes AI.
Right. So I think that, and number one holding there is MicroStrategy. Is that right?
Yeah, and so it's equal weighted, the fund. This is a great point because I've seen a lot of stuff on social media about this. Like, how is MicroStrategy, an AI fund? Well, MicroStrategy isn't actually initially an AI company. It's just that they invest so much in Bitcoin, and so because they've had so much price appreciation in an equal weighted fund, their holding goes up. But the fund is rebalanced, which has worked out for investors. So, great. But the fund is rebalanced on a quarterly basis because we wanted to make sure that like you keep the integrity of, AI, quantum computing, and, connective technology, all that kind of stuff. So, yeah.
Okay. Does that follow what the index does too?
Yeah, exactly. Passive index based. We track the MBIS Blue Star, AI machine learning index. So, which we worked on with them. So 5G again, we were thinking about like AI and tech, and then we thought like, is it one ETF or two? And we came to the conclusion that it's actually two because, so 5G is everything from upgrading your Apple phone, right? And T-Mobile and like the classic 5G networks and things like that. But then 5G is also necessary for things like smart cars and smart cities and like military teleconnectivity, communications, and things like that. So that has some, like cell tower REITs in there. It has mobile companies. It has chips, obviously, because they're still the bread and water of both 5G and AI. But we actually think of the ETF as like the next generation of tech connectivity. And so it can be 6G, it can be 7G, it's going to be whatever the necessary stocks are to power AI, power machine learning, power that like lower latency that we were talking about for quantum computing. So it has more of that like communications connectivity tech theme to it.
Now, I really appreciate people like Sylvia and other fund managers coming out and getting in front of their products to talk about them and explain them to us so we can have a better understanding of exactly how they work and why they wanted to bring them to market in the first place. So I'm curious to hear your thoughts. Let me know down in the comments what you think. Is there anything that you really like, or is there something that you really don't like? Let me know down below. Appreciate you watching. Have a great night. Take care. We'll see you next time.